Australia's fake quantitative tightening program. Martin North, John Adams, and Interest People. Hi, John.
Hello, sir.
Back in the studio once again, and we're going to talk about the RBA and QT and whether it's real or not.
Yes. What I'll say, Martin, is that I think next week is quite significant. So the RBA board is meeting on Tuesday, and a lot of people across the country are going to be quite nervous about what the RBA does. We've been warning on the show for many, many years about the dangers of debt. And during the pandemic, a lot of people didn't listen to our warnings and they dived right in, and with FOMO and everything else. And a lot of people signed mega mortgages of high six-figure, seven-figure mortgages. And while we had a 0.25% increase in official interest rates in May, the consensus, according to the Financial Review this morning, was that it will be 0.4%. Taking the cash rate to 0.75, and that will be quite surprising. Just in the last couple of weeks when I've mentioned the prospect of a 0.4% increase, people have been quite alarmed by that level of increase, although we do have some voices out there calling for 0.65 and 0.85 next week. So obviously interest rates are going up, and people should, if you do have a mortgage, particularly if you're on variable interest, you should brace for additional costs beyond all the other cost of living pressures and then the inflation that's happening across the economy. But then once we get into particularly next year, there's a very big, interesting sort of cliff which the RBA has presented last week, which is about quantitative tightening. And that's what we're going to talk about today, and whether this program that the RBA has rolled out is realistic, is it fake, is it a fantasy? Because if they do what they say they're going to do, it is going to be good night for many families across the country.
Yeah, absolutely. And it's just worth, I think, making 2 points about the official cash rate. That is not directly correlated necessarily to mortgage rates. In fact, a number of banks this week have put their fixed rate mortgages up quite a lot. In some cases, 0.8% already. So there's a big gap now between the variable interest rate mortgage and the fixed rates over 3 or 4 or 5 years. And the other point to make is that in New Zealand a couple of weeks ago, they put the cash rate up 0.5%. They're now at 2%. So the concept of moving it up by more than 0.25% is something we probably should embrace. And of course, there's talk in the US, the Fed is going to do the same when they meet in a week or so's time. So we are in an interesting position with rates going up, mortgage rates going up. And what I find when I talk to people is a lot of people are only just beginning to wake up to what this really means. And just to remind everybody, a 1% rise in the mortgage rate for a typical mortgage is a 15% increase in the monthly repayments on a principal interest mortgage. So these have a very significant upward impact on household budgets and households. And of course, at the time when costs of living are rising, inflation's raging, the power and the gas and everything is there too. So all of those factors have come together.
Yes, there's probably 2 points I'll add to that, Martin. Is the first one, and on this issue of quantitative tightening, I've just published an article on my website, and perhaps we'll put that on the screen for people to have a look at, and feel free to read the article after the show. But as I was doing the work this week, researching the article, I probably didn't fully appreciate that before last month, as in May, because we're now recording in June, the last time that rates went up in this country was November 2010. And so there's a whole generation of new borrowers, new homeowners who have never experienced rising rates, but then obviously more experienced and seasoned house owners or property owners. It's perhaps a distant memory of what is it like when rates go up. So that I think is a very interesting phenomena. The psychology of people who are used to low rates for too long, and one of the things we were just saying off camera is unfortunately. There's too many people who got duped by economists who don't know what they're talking about. Now, people like to take shots at me and says that I'm, a lunatic, I'm a nutcase, I don't really understand what I'm talking about when I talk about economics, and no doubt you've had plenty of critics yourself, but Now, I mean, two key points on this is we've had the RBA governor last November saying right throughout 2021, rates will only start to rise in 2024. And he said it as late as November. And while I think this guy's incompetent and he shouldn't be in the job, a lot of people, a lot of normal mums and dads, as well as the mainstream media, give the governor too much credibility, and people made financial decisions based on the expectations he attempted to set. And now people's household budgets are going to be blown to smithereens because, again, he's not a politician; he's a bureaucrat. And I mean, it wasn't a so-called political promise, but he would say, well, that's the best information we had at that point in time. And now that the evidence has changed, we're changing our position based on the new evidence. Even though in 2020, you and I were basically warning the alarm bells of stagflation, rising inflation rates, too much money printing, and what that will mean over the medium term. So that's point one. But point two is some of these so-called respected private market economists, and I'll call out two. One's Stephen Koukoulous, the Kook, and the other one is Peter Tulip. Now, Peter Tulip is a former RBA official who's now at the Centre for Independent Studies, and even the AFR went to town on them today and said that in 2020, both of these gentlemen were two of the biggest doves, calling for dramatic reductions in interest rates, even though I basically said it was catastrophic economic mistake. And now these two are basically criticising the RBA for leaving rates too low for too long, and now they're saying you need to be super aggressive in terms of trying to catch up with all the other central banks. So, and what I think these gentlemen don't understand is, one, they misjudged their analysis in 2020, and now in 2022 they have no real concept of what does it mean for the average mum and dad family when they start to say we need to raise rates by I mean, like in the case of Koukoulous, he wants basically almost a 2% rate rise in about 3 months. And what that means, so you were just talking about a 1% mortgage rate rise. Well, if you get 2% in 3 months, what is that going to do for a 30% increase in repayments? A lot of families are doing it tough right now.
The other point I'd make, John, is that the data that came out today on the new credit flows from the ABS was down quite a lot, quite starkly down, actually. And the other thing that we should bear in mind is we're going to start seeing a credit crunch now, because essentially your ability to borrow is being reduced because the interest rates are already going up.
Yes.
The loan to income and debt to income ratios by some lenders are being reduced. And what that means is that basically people won't be able to get as much now as they could 1 or 2 months ago. So we're already starting to see, as well as the pressure on incomes, people's inability to grab mortgages that they could have got 2 or 3 months ago. The slowing of credit is something else to bear in mind here, because that's going to be really very strong as rates go higher.
There was a speech last week by Dr. Chris Kent, who's an assistant governor at the RBA, to talk about the commencement of quantitative tightening. And one of the extraordinary sentences in the report was that he suggested that they did a market survey at the end of last year, and everyone so supposedly the market economists expected inflation to remain low throughout 2022. So I mean that just shows you how poor the forecasting is across the market. So now,
well, they didn't ask us.
no, thing is, like they absolutely didn't come here and basically say to us. I would have said to them last year that forget about the ABS's CPI. I mean, you can just look at property prices and you can tell that there is a huge inflation problem occurring in terms of real time.
A lot of organisations, the HIA, for example, and REA, everyone's got their own in-house economists. The banks have their own in-house economists.
Yes.
Right? People need to understand all of those economists have a story to tell based on where they are.
Yes.
They are, frankly, cash for comment.
Yes.
Right? And that basically means that they are not giving you an objective, independent view. They are giving you a view based on where they are, their position, the organisation that they represent. And therefore, when they say, house prices aren't going to fall very much, or, it's all going to be fine, or whatever it is, just bear in mind they have an axe to grind.
Now, so beyond the raising of rates, what the RBA announced last month was the commencement of quantitative tightening. So all of this money that they have pushed out into the market, they now want to reverse it. And why? Because they want to basically try to get the RBA into some normality in terms of where it was before the pandemic, so that it can show that it actually has a manageable and responsible balance sheet. Because
you just mentioned that the balance sheet has absolutely exploded, hasn't it?
Precisely. So now what the RBA has suggested is that they're going to do two things. Now, if we can put slide 2 on the screen, Martin. So this is a graph from Dr. Kent's speech, and this is the quantitative tightening program. So it consists of two components. One is all these government bonds that they bought through market function, yield curve control, and QE. They're going to allow these to mature, and they're not going to buy them back. So what that means is that basically once the bond matures, the Treasury will basically give the money, the principal back to the RBA, and then the Treasury will have to reissue the next series of bonds into the private secondary market, and that will increase the supply of bonds, and with more bonds, that pushes the interest rates up. So that's what happens on the bonds. In relation to the term funding facility, what the RBA is requiring is that of the $188 billion that they lent, they want $85 billion paid in 2023, and they want the remaining to be paid in 2024. So what that means is basically all this super cheap money of 0.1%, the banks have to give that back to the RBA, and then they have to go substitute that capital by going to borrow from the capital markets. And obviously in an environment where rates are going up, and supposedly it's going to continue to go up next year, the increase in funding costs for the banks could be easily a couple of percent, and that for the banks is a big deal.
Yeah, and of course the other thing they can do is to try and get more deposits. So you'll see that the deposit rates on term deposits have started to go up. That's the banks trying to actually pull some of that funding back in, because there's a lot of deposit money out there as well. But the funding pressures on the banks over the next year or two are going to be pretty extreme. The margins are already being compressed. And with higher funding internationally as well as in Australia, it's going to be very interesting to watch.
Yes. So when we start to think of, okay, so we have rising rates in 2022, we have this program where particularly in 2023, 2024. So actually I should say that just in terms of this QT program, the quantity for this year is only $4 billion. So it's very minor, but then it starts to really ramp up next year and the year after. So what does that mean? It means that the RBA in effect is going to pull from the market a lot of cheap funding,
yep.
and then the banks and the governments have to get that funding at a more expensive cost, and that obviously means that in terms of the government, that's going to make fiscal policy harder to manage and potentially could put the AAA credit rating at risk. But also for the banks, if they have a more expensive in terms of capital funding, that means they've got to pass those costs on to consumers. And obviously, like you said before, some banks have already started to lift in terms of their fixed rate products. But obviously, what you and I have discussed off camera is we don't think that some of these new additional funding costs that are coming next year and the year after have been factored in. So in reality, if this program were to be conducted in the manner in which the RBA is now telling the market it's going to be, well, so people last year were borrowing at 1.8, 1.9% in terms of their mortgages. Fixed rates, variable rates. I even when I went to my local credit union to have a look, some variable rate products around 2.5, 2.6, fixed rates around 4, 4.5. So it could well be, once you start to mix this all together, you could start to see mortgage rates at about 6, 7, 8% variable or fixed, depending on how aggressive that they want to be. And I remember when I took my first mortgage out in 2009, we were paying, I think, 6.75%, because that was the interest rate just shortly after the GFC. And there is no, I have a view that households and the economy cannot take mortgage rates at that level, because even those people who took a mortgage in the last couple of years, I mean, the APRA, Australian Prudential and Regulatory Authority, introduced this so-called buffer test. So when people went to get a mortgage, they were assessed by the banks at about 2.5% to 3% above the rate that they were signing the contract for. But if we're now saying that with short-term rates going up and this QT program pushing rates at well above 3%, a lot of these people who were assessed during the pandemic as being able to repay the mortgage, this whole program would suggest that the cost will be well above the buffer. And again, you've got the more accurate assessment as to how many, if we've got, what are we now, 43% mortgage stress?
1.5 million.
1.5 million people.
Yep.
Well, if this program was to be fully implemented the way the RBA is saying it's going to be implemented, what is the impact on households across the country, Martin?
Getting close to 2 million would be in stress. That's cash flow. It doesn't mean they're all going to fall over tomorrow, but it does mean they're going to struggle, significantly struggle. And of course, the other pressures are still there, the cost of living. And by the way, putting interest rates up is to an extent inflation, isn't it? Because those higher costs have to be borne by businesses who in turn have to pass those charges on, perhaps through higher costs of their goods sold through the market. So wherever you look, this is bad news.